Getting ready for the Safe Mortgage Loan Originator exam? This video covers federal laws, loan types, the loan process, ethics, and uniform state test topics. Everything you need to know. It's all here to help you study smarter and pass with confidence. And don't miss what's happening in the lower corner. We'll explain that in just a minute. Now, let's get started.
Federal mortgage-related laws. Truth in Lending Act. Which of the following is a primary purpose of the Truth in Lending Act? Is it A, to promote informed use of consumer credit? B, to regulate interest rates set by lenders? C, to determine eligibility for federal mortgage programs? Or D, to provide tax incentives for home loans? The answer is A, to promote informed use of consumer credit. TILA is designed to promote informed use of consumer credit by requiring disclosures about terms and costs. It aims to protect consumers in credit transactions by ensuring they receive meaningful information. Under TILA, which document must creditors provide to consumers to disclose the cost of credit? Is it A, credit report, B, deed of trust, C, loan estimate, or D, title insurance? The answer is C, loan estimate. The loan estimate is required under TILA to disclose important details about a mortgage, including interest rates, monthly payments, and total closing costs, helping consumers understand the financial implications.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsy.ai for immediate help and a free study session with Birdsy, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
What is the primary feature of the right of rescission under TILA? Is it A, allows consumers to increase loan amounts? B, permits cancellation of certain credit transactions within 3 days? C, mandates lenders to lower interest rates? Or D, requires disclosure of annual percentage rates? The answer is B, permits cancellation of certain credit transactions within 3 days. The right of rescission allows consumers to cancel certain credit transactions, such as a refinance, within 3 business days. This provides a safeguard for borrowers to reconsider their decision. Which transactions are typically exempt from the TILA right of rescission? Is it A, home equity loans, B, refinancing with a new lender, C, second mortgages, or D, purchase of a primary residence? The answer is D, purchase of a primary residence. The right of rescission does not apply to the purchase of a primary residence or initial mortgage loans. It is mainly applicable to refinancing and home equity loans on a primary residence. Real Estate Settlement Procedures Act. What is the primary purpose of the Real Estate Settlement Procedures Act? Is it A, to protect consumers by ensuring they receive disclosures about the costs of real estate settlements? B, to regulate the interest rates charged by mortgage lenders? C, to provide tax incentives for first-time homebuyers? Or D, to standardize the appraisal process for real estate transactions? The answer is A, to protect consumers by ensuring they receive disclosures about the costs of real estate settlements. RESPA aims to protect consumers by ensuring they receive disclosures about the costs of real estate settlements and eliminating abusive practices. It helps consumers become better shoppers for settlement services. Which of the following transactions is not covered by RESPA? Is it A, a loan for a single-family home, B, a refinance of a home mortgage, C, a loan for a commercial office building, or D, a loan for a condominium unit? The answer is C, a loan for a commercial office building. RESPA covers most residential property transactions, but it does not apply to business purpose loans, such as commercial real estate transactions, which are outside its scope. Under RESPA, how soon must a lender provide a borrower with a good faith estimate after receiving a loan application? Is it A, immediately upon application receipt, B, within 3 business days, C, within 1 week, or D, before the loan closing? The answer is B, within 3 business days. Lenders must provide a good faith estimate within 3 business days of receiving a loan application. This requirement ensures borrowers are informed about expected settlement costs early in the process. Which of the following practices is prohibited by RESPA? Is it A, kickbacks and referral fees for settlement services, B, discounts on closing costs for repeat customers, C, providing a list of preferred service providers, or D, charging a flat fee for settlement services? The answer is A, kickbacks and referral fees for settlement services. RESPA prohibits kickbacks and referral fees that unnecessarily increase the cost of settlement services. This provision aims to prevent conflicts of interest and protect consumers from excessive costs.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Equal Credit Opportunity Act. Under the Equal Credit Opportunity Act, which of the following is a prohibited basis for denying credit? Is it A, employment status, B, age, C, credit score, or D, educational background? The answer is B, age. ECOA prohibits credit discrimination based on race, color, religion, national origin, sex, marital status, age, or because someone receives public assistance. Denying credit based on age is illegal unless age is a valid predictor of creditworthiness. What is the primary purpose of the Equal Credit Opportunity Act? Is it A, to regulate interest rates on loans, B, to protect consumers from predatory lending, C, to prohibit discrimination in credit transactions, or D, to ensure banks have sufficient reserves? The answer is C, to prohibit discrimination in credit transactions. ECOA aims to ensure all consumers are given an equal chance to obtain credit. It prohibits discrimination in credit transactions based on race, color, religion, national origin, sex, marital status, age, or public assistance. Which of the following actions is required by lenders under the Equal Credit Opportunity Act when denying a credit application? Is it A, provide a written statement of reasons for denial, B, offer an alternative loan product, C, notify the applicant by phone, or D, automatically reevaluate the application in 30 days? The answer is A, provide a written statement of reasons for denial. ECOA requires lenders to provide a written statement of reasons for denial or inform the applicant of their right to receive such a statement. This helps ensure transparency and accountability in credit decisions. Which characteristic is not protected under the Equal Credit Opportunity Act? Is it A, marital status, B, national origin, C, public assistance, or D, sexual orientation? The answer is D, sexual orientation. ECOA protects against discrimination based on race, color, religion, national origin, sex, marital status, age, or public assistance. It does not specifically address sexual orientation, although other laws may cover this. Home Ownership and Equity Protection Act. What is the primary purpose of the Home Ownership and Equity Protection Act? Is it A, to protect consumers from predatory lending practices, B, to increase the availability of mortgage loans, C, to lower interest rates on all types of mortgages, or D, to eliminate all adjustable rate mortgages? The answer is A, to protect consumers from predatory lending practices. HOEPA was enacted to protect consumers against predatory lending practices by imposing strict disclosure requirements and prohibiting certain terms in high-cost mortgages. It aims to prevent abusive practices in the mortgage market. Which of the following is a key requirement under HOEPA for high-cost mortgages? Is it A, mandatory arbitration clauses, B, additional disclosures to borrowers, C, waiver of consumer rights, or D, unlimited prepayment penalties? The answer is B, additional disclosures to borrowers. HOEPA requires lenders to provide additional disclosures and prohibits certain loan terms for high-cost mortgages to protect consumers from unfair practices. Under HOEPA, which of the following loan features is prohibited in high-cost mortgages? Is it A, fixed interest rates, B, interest-only payments, C, balloon payments, or D, escrow accounts for taxes? The answer is C, balloon payments. HOEPA prohibits certain loan features, such as balloon payments, in high-cost mortgages to prevent borrowers from facing unaffordable payments. What is the threshold for a loan to be considered a high-cost mortgage under HOEPA? Is it A, APR exceeds the prime rate by 1%, B, points and fees exceed 2% of the loan amount, C, loan term exceeds 30 years, or D, APR exceeds the average prime offer rate by 6.5% or points and fees exceed 5% of the loan amount? The answer is D. APR exceeds the average prime offer rate by 6.5% or points and fees exceed 5% of the loan amount. A loan is considered high cost if its APR exceeds the average prime offer rate by specific margins, or if points and fees exceed a set percentage of the loan amount.
Notice the code in the corner? When you're stumped by a question, enter it at birdsy.ai for immediate help. Enjoy complimentary study sessions and access to hundreds of additional questions to help you pass your exam with confidence.
Fair Credit Reporting Act and FACTA. Under the Fair Credit Reporting Act, which of the following entities can access a consumer's credit report without their explicit consent? Is it A, a potential employer, B, a creditor evaluating a credit application, C, a landlord screening a rental application, or D, a marketing company? The answer is B, a creditor evaluating a credit application. The FCRA allows creditors to access a consumer's credit report without explicit consent if they have a legitimate business need, such as evaluating a credit application. Other entities typically require consumer consent. What is the primary purpose of the Fair and Accurate Credit Transactions Act? Is it A, to allow creditors unlimited access to consumer credit reports, B, to eliminate all credit reporting agencies, C, to enhance consumer protections against identity theft, or D, to provide free credit scores to consumers? The answer is C, to enhance consumer protections against identity theft. FACTA aims to enhance consumer protections against identity theft and ensure the accuracy of credit information. It provides consumers with free annual credit reports and addresses identity theft concerns. Which of the following rights is granted to consumers under the FCRA regarding their credit reports? Is it A, the right to dispute inaccuracies in their credit reports, B, the right to demand higher credit scores, C, the right to delete accurate negative information, or D, the right to access their credit report every month for free? The answer is A, the right to dispute inaccuracies in their credit reports. The FCRA grants consumers the right to dispute inaccuracies in their credit reports. This ensures the information is accurate and up to date, protecting consumers from potential negative impacts. What is one of the key protections FACTA provides to consumers concerning identity theft? Is it A, the ability to change their Social Security number, B, the requirement for credit reports to be deleted every 7 years, C, the right to have all debts forgiven. Or D, the ability to place fraud alerts on their credit reports. The answer is D, the ability to place fraud alerts on their credit reports. FACTA allows consumers to place fraud alerts on their credit reports to prevent identity theft. This alerts creditors to take extra steps to verify identity before granting credit. Other federal laws. Which of the following is a primary purpose of the Home Mortgage Disclosure Act? Is it A, to regulate interest rates on mortgages, B, to provide tax incentives for home buyers, C, to ensure transparency in mortgage lending practices, or D, to offer government-backed mortgage insurance? The answer is C, to ensure transparency in mortgage lending practices. HMDA aims to provide the public with loan data that can be used to determine whether financial institutions are serving the housing needs of their communities and to identify possible discriminatory lending patterns. Under the Mortgage Acts and Practices Rule, which of the following is considered a deceptive act? Is it A, accurate disclosure of loan fees, B, misleading claims about loan terms, C, providing a clear loan estimate, or D, offering lower interest rates? The answer is B, misleading claims about loan terms. The MAP rule prohibits misleading advertising practices by mortgage lenders, including false statements about loan terms, rates, or any features that can deceive consumers. What is a key requirement for lenders under the HMDA regarding loan data? Is it A, annual reporting of loan data, B, monthly submission of interest rates, C, quarterly updates on borrower credit scores, or D, biannual audits of loan approvals? The answer is A, annual reporting of loan data. Lenders must collect and report specific loan data annually, including information about the applicant, loan type, and property location, to help identify discriminatory lending practices. How does the MAP rule affect mortgage advertising practices? Is it A, allows flexibility in advertising, B, prohibits misleading representations, C, mandates the use of specific advertising formats, or D, requires advertisements to be reviewed by the FTC? The answer is B, prohibits misleading representations. The MAP rule prohibits false or misleading representations in mortgage advertising, ensuring that consumers receive truthful information about loan products and terms. General mortgage knowledge. Mortgage loan products. Which type of mortgage loan allows the borrower to make interest-only payments for a specified period before principal payments are required? Is it A, fixed-rate mortgage, B, interest-only mortgage, C, adjustable-rate mortgage, or D, balloon mortgage? The answer is B, interest-only mortgage. An interest-only mortgage allows borrowers to pay only interest for a set period, typically 5 to 10 years. After this period, the loan converts to a conventional amortization schedule, increasing monthly payments. What is a key feature of a reverse mortgage? Is it A, requires monthly principal payments, B, available to anyone regardless of age, C, converts home equity into cash, or D, typically has a fixed interest rate? The answer is C, converts home equity into cash. Reverse mortgages allow homeowners aged 62 and older to convert home equity into cash without monthly mortgage payments. The loan is repaid when the borrower sells the home or passes away. Which mortgage product is designed to assist low-income borrowers by offering lower down payments and flexible credit requirements? Is it A, Federal Housing Administration, FHA loan, B, conventional loan, C, U.S. Department of Veterans Affairs, VA loan, or D, jumbo loan? The answer is A, Federal Housing Administration, FHA loan. FHA loans are insured by the Federal Housing Administration and offer lower down payments and flexible credit requirements, making them accessible to low-income borrowers. What distinguishes a jumbo loan from a conforming loan? Is it A, lower interest rates, B, loan amounts exceeding conforming limits, C, government insurance, or D, easier approval process? The answer is B, loan amounts exceeding conforming limits. Jumbo loans exceed the conforming loan limits set by Fannie Mae and Freddie Mac, requiring stricter credit and down payment criteria due to their higher risk. Mortgage terminology and concepts. What is the primary purpose of a mortgage amortization schedule? Is it A, to determine the interest rate of the loan, B, to calculate the total loan amount, C, to show the breakdown of each payment into principal and interest, or D, to adjust the loan term? The answer is C, to show the breakdown of each payment into principal and interest. A mortgage amortization schedule outlines each payment over the life of the loan, showing how much goes towards principal and interest. This helps borrowers understand the loan's progression and the impact of additional payments. What does the term LTV stand for in mortgage terminology? Is it A, loan to value, B, loan to volume, C, lease to value, or D, lease to volume? The answer is A, loan to value. LTV stands for loan to value ratio, which is the ratio of a loan to the value of the purchased property. It is crucial in assessing lending risk, with lower ratios generally indicating less risk. Which of the following best describes a balloon payment in a mortgage? Is it A, a payment made at the beginning of the loan, B, a large payment due at the loan's end, C, a regular monthly payment, or D, an interest-only payment? The answer is B, a large payment due at the loan's end. A balloon payment is a large payment due at the end of a loan term, following smaller periodic payments. It is common in loans with shorter terms and lower initial payments. What is PMI in the context of mortgages? Is it A, primary mortgage interest, B, public mortgage insurance, C, personal mortgage investment, or D, private mortgage insurance? The answer is D, private mortgage insurance. PMI stands for private mortgage insurance, which protects lenders against borrower default. It is typically required when a borrower makes a down payment of less than 20% of the home's purchase price. Types of mortgage instruments. Which type of mortgage instrument involves a fixed interest rate and fixed monthly payments throughout the life of the loan? Is it A, fixed rate mortgage, B, adjustable rate mortgage, C, balloon mortgage, or D, interest-only mortgage? The answer is A, fixed-rate mortgage. A fixed-rate mortgage offers stability with consistent monthly payments and interest rates. This predictability makes it a popular choice for borrowers seeking long-term financial planning. What is a characteristic of an adjustable-rate mortgage? Is it A, fixed interest rate, B, interest-only payments, C, interest rate adjustments, or D, large final payment? The answer is C, interest rate adjustments. An adjustable rate mortgage offers an initially lower interest rate that adjusts periodically based on an index. This can lead to lower initial payments, but introduces potential payment variability. Which mortgage instrument allows borrowers to pay only the interest for a specified period? Is it A, balloon mortgage, B, interest-only mortgage, C, fixed-rate mortgage, or D, reverse mortgage? The answer is B, interest-only mortgage. Interest-only mortgages enable borrowers to pay only the interest for a set period, usually resulting in lower initial payments but potential payment increases later. What distinguishes a reverse mortgage from other types of mortgages? Is it A, fixed monthly payments, B, variable interest rate, C, large final payment, or D, no monthly payments? The answer is D, no monthly payments. Reverse mortgages allow homeowners, typically seniors, to convert home equity into cash without monthly payments, repaid upon sale or death, offering financial flexibility in retirement.
Stuck on a question? Just think of the Birdsy link in the description as your friendly neighborhood superhero, swooping in to save the day with answers. Feel free to explore it now and return to continue. Simply hit pause, and we'll be waiting when you get back.
Secondary market and investor guidelines. What is the primary function of the secondary mortgage market? Is it A, to provide liquidity to lenders by purchasing existing mortgages? B, to offer homebuyers lower interest rates directly? C, to originate new loans for borrowers? Or D, to insure mortgages against default? The answer is A, to provide liquidity to lenders by purchasing existing mortgages. The secondary mortgage market allows lenders to sell loans, thereby replenishing their funds to issue new loans. This market helps maintain liquidity and stability in the mortgage industry. Which agency is known for guaranteeing mortgage-backed securities in the secondary market? Is it A, Fannie Mae, B, Ginnie Mae, C, Freddie Mac, or D, Federal Reserve? The answer is B, Ginnie Mae. Ginnie Mae guarantees mortgage-backed securities, ensuring investors receive payments even if borrowers default. This guarantee makes the securities more attractive to investors. How do mortgage-backed securities benefit investors in the secondary market? Is it A, by offering tax incentives for mortgage investments? B, by allowing direct investment in individual mortgages? C, by providing a diversified income stream from pooled mortgage payments? Or D, by guaranteeing a fixed rate of return? The answer is C, by providing a diversified income stream from pooled mortgage payments. Mortgage-backed securities provide investors with a steady income stream from mortgage payments while diversifying risk across multiple loans, reducing the impact of any single default. What role does Fannie Mae play in the secondary mortgage market? Is it A, it insures mortgages against default? B, it originates new loans for homebuyers? C, it regulates mortgage interest rates? Or D, it purchases mortgages to provide liquidity to lenders? The answer is D, it purchases mortgages to provide liquidity to lenders. Fannie Mae buys mortgages from lenders, which provides them with funds to issue more loans. This process helps stabilize the housing market by ensuring consistent loan availability. Risk analysis and underwriting principles. What is the primary purpose of a borrower's debt-to-income ratio in mortgage underwriting? Is it A, to evaluate the borrower's credit score? B, to determine the value of the property? C, to assess the borrower's ability to repay the loan? Or D, to verify the borrower's employment status? The answer is C, to assess the borrower's ability to repay the loan. The debt-to-income ratio helps lenders assess a borrower's ability to manage monthly payments and repay debts. It is a crucial factor in determining loan approval and risk management. Which factor is most critical in determining the interest rate offered to a borrower? Is it A, the location of the property? B, the borrower's credit score? C, the size of the down payment? Or D, the type of property being financed? The answer is B, the borrower's credit score. A borrower's credit score significantly influences the interest rate as it reflects their creditworthiness and risk level to lenders. How does loan-to-value ratio impact mortgage risk analysis? Is it A, higher LT ratios increase lender risk? B, lower LTV ratios increase lender risk? C, LTV ratio has no impact on risk? Or D, LTV ratio only affects interest rates? The answer is A. Higher LTV ratios increase lender risk. A higher LTV ratio indicates greater risk for lenders as the borrower has less equity in the property, increasing the likelihood of default. What is the significance of a borrower's employment history in underwriting? Is it A. It determines the loan term length. B. It affects the property's appraisal value. C. It sets the borrower's credit score. Or D. It indicates income stability. The answer is D. It indicates income stability. A stable employment history provides lenders with confidence in the borrower's ability to maintain income and meet mortgage obligations, reducing the risk of default. Loan origination activities. Loan application process. What is the primary purpose of a loan application in the loan origination process? Is it A. To finalize the loan agreement? B. To collect borrower information for eligibility assessment? C. To set the loan interest rate? Or D. To provide a loan estimate? The answer is B. To collect borrower information for eligibility assessment. The loan application serves as the initial document through which a borrower provides necessary personal, financial, and property information. This information is crucial for lenders to assess the borrower's creditworthiness and determine loan eligibility. Which document is typically required to verify a borrower's income during the loan application process? Is it A. Pay stubs, B. Credit report, C. Title deed, or D. Appraisal report? The answer is A. Pay stubs. Pay stubs are commonly used to verify a borrower's income as they provide direct evidence of earnings. Lenders use this information to assess the borrower's ability to repay the loan. What is the significance of the debt-to-income ratio in the loan application process? Is it A. It determines the loan term, B. It sets the property value, C. It evaluates the borrower's repayment capacity, or D. It is used to calculate closing costs? The answer is C. It evaluates the borrower's repayment capacity. The DTI ratio is crucial as it helps lenders evaluate the borrower's ability to manage monthly payments and debts. A lower DTI indicates a better balance between debt and income, influencing loan approval. Which of the following is a common reason for a loan application denial? Is it A. High property value, B. Low debt-to-income ratio, C. Adequate income documentation, or D. Poor credit history? The answer is D. Poor credit history. A poor credit history often leads to loan application denials as it indicates a higher risk of default. Lenders prefer borrowers with a strong history of managing credit responsibly. Verification and documentation requirements. What is the primary purpose of verifying a borrower's employment during the loan origination process? Is it A. To determine the borrower's job satisfaction, B. To evaluate the borrower's career growth potential, C. To confirm the borrower's stable income source, or D. To assess the borrower's work environment? The answer is C. To confirm the borrower's stable income source. Verifying a borrower's employment ensures they have a stable source of income to repay the loan. This is crucial for assessing the borrower's creditworthiness and minimizing default risk. Which document is typically required to verify a borrower's income during the loan origination process? Is it A. Pay stubs, B. Credit report, C. Driver's license, or D. Utility bill? The answer is A. Pay stubs provide recent evidence of income and employment, making them essential for verifying a borrower's financial capacity to repay the loan. Why is it important to verify a borrower's assets during the loan origination process? Is it A. To check the borrower's spending habits, B. To confirm funds for down payment and closing costs, C. To evaluate the borrower's investment portfolio. Or D. To determine the borrower's net worth. The answer is B. To confirm funds for down payment and closing costs. Verifying assets ensures the borrower has sufficient funds for the down payment and closing costs, which is crucial for loan approval and reducing lender risk. What is the significance of obtaining a credit report in the loan origination process? Is it A. To verify the borrower's employment history, B. To assess the borrower's current income, C. To evaluate the borrower's housing expenses, or D. To review the borrower's credit history and score? The answer is D. To review the borrower's credit history and score. A credit report provides a detailed history of the borrower's credit behavior, which helps lenders assess creditworthiness and the risk of loan default.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsy.
Qualifying borrowers and calculating ratios. What is the maximum debt-to-income ratio typically allowed for a conventional loan? Is it A. 28%, B. 36%, C. 43%, or D. 50%? The answer is B. 36%. The maximum debt-to-income ratio for a conventional loan is generally 36%, but it can go up to 45% with compensating factors. This ratio helps lenders assess a borrower's ability to manage monthly payments. Which of the following is considered a compensating factor when qualifying a borrower for a mortgage? Is it A. High credit score, B. Multiple credit inquiries, C. Low down payment, or D. Unstable employment history? The answer is A. High credit score. A high credit score can be a compensating factor, allowing lenders to approve a loan with a higher DTI ratio. Compensating factors help mitigate risk for lenders. How is the front-end ratio calculated when assessing a borrower's qualification for a mortgage? Is it A. Total monthly debts divided by net monthly income, B. Total monthly housing expenses divided by net monthly income, C. Total monthly housing expenses divided by gross monthly income, or D. Total monthly debts divided by gross monthly income? The answer is C. Total monthly housing expenses divided by gross monthly income. The front-end ratio is calculated by dividing the total monthly housing expenses by the borrower's gross monthly income. This ratio helps determine if housing costs are manageable. Why is the verification of employment critical in the loan origination process? Is it A. To determine the borrower's credit score, B. To confirm the borrower's income stability, C. To assess the borrower's property value, or D. To calculate the borrower's total debt? The answer is B. To confirm the borrower's income stability. Verification of employment ensures the borrower has a stable income source, which is crucial for assessing their ability to repay the loan. Lenders need assurance of consistent income. Disclosures and timing requirements. What is the primary purpose of the loan estimate disclosure in the loan origination process? Is it A. To finalize the loan agreement with the borrower, B. To provide a summary of key loan terms and estimated costs, C. To inform the borrower of loan approval, or D. To detail the borrower's credit score and history? The answer is B. To provide a summary of key loan terms and estimated costs. The loan estimate disclosure provides borrowers with a clear summary of key loan terms, helping them understand and compare offers. It must be delivered within 3 business days of receiving a loan application. When must the closing disclosure be provided to the borrower? Is it A. 1 business day before closing, B. On the day of closing, C. 3 business days before closing, or D. A week after the loan application? The answer is C, 3 business days before closing. The closing disclosure must be provided at least 3 business days before closing. This allows borrowers time to review final terms and costs, ensuring transparency and informed consent. Which of the following triggers the requirement to provide a revised loan estimate? Is it A, a change in the loan amount? B, the borrower requests a copy of their credit report? C, the borrower changes their mailing address? Or D, the lender updates their contact information? The answer is A, a change in the loan amount. A change in loan terms, such as the loan amount or interest rate, requires a revised loan estimate. This ensures borrowers are informed of any significant changes affecting their loan. What is the maximum allowable variance between the loan estimate and the actual closing costs for services the borrower can shop for? Is it A, 0%, B, 5%, C, 15%, or D, 10%? The answer is D, 10%. For services the borrower can shop for, the costs can vary, but the total cannot increase by more than 10% unless a valid change of circumstances occurs, ensuring cost transparency. Closing process and funding. What is the primary purpose of the closing disclosure in the loan origination process? Is it A, to provide the borrower with a loan approval status? B, to outline the final terms and costs of the mortgage transaction? C, to initiate the loan funding process? Or D, to verify the borrower's creditworthiness? The answer is B, to outline the final terms and costs of the mortgage transaction. The closing disclosure provides the borrower with a detailed account of the final terms and costs of the mortgage transaction. It ensures transparency and allows the borrower to compare final terms with the initial loan estimate. Which party is primarily responsible for ensuring that all documents are signed and funds are dispersed during the closing process? Is it A, the borrower, B, the lender, C, the closing agent, or D, the real estate agent? The answer is C, the closing agent. The closing agent or settlement agent coordinates the signing of documents and disbursement of funds. They ensure all necessary steps are completed for a successful closing. Why is a title search conducted before closing a mortgage loan? Is it A, to confirm the property is free of liens or claims? B, to determine the property's market value? C, to finalize the loan terms with the lender? Or D, to schedule the closing date with all parties? The answer is A, to confirm the property is free of liens or claims. A title search is conducted to ensure the property is free of liens or claims. This protects the lender and borrower by verifying the seller's legal right to transfer ownership. What is the significance of the funding date in the closing process? Is it A, it determines when the borrower must start making payments? B, it marks the end of the underwriting process? C, it is when the borrower receives the closing disclosure? Or D, it is when the lender disperses the loan funds? The answer is D, it is when the lender disperses the loan funds. The funding date is when the lender disperses the loan funds to the borrower or seller. It marks the transaction's completion and the transfer of property ownership. Ethics, fraud prevention and detection. Which of the following is a key component of an effective fraud prevention policy? Is it A, regular audits, B, whistleblower hotline, C, employee background checks, or D, detailed financial reporting? The answer is B, whistleblower hotline. An effective fraud prevention policy includes a whistleblower hotline to encourage reporting of suspicious activities, thereby deterring fraud and promoting ethical behavior within the organization. What is the primary goal of fraud detection systems in an organization? Is it A, Identify potential fraudulent activities early. B. Punish perpetrators after fraud occurs. C. Reduce operational costs. Or D. Enhance employee productivity. The answer is A. Identify potential fraudulent activities early. The primary goal of fraud detection systems is to identify potential fraudulent activities early, allowing for swift action to prevent further damage and maintain organizational integrity. Which technique is most effective in detecting fraudulent activities in financial transactions? Is it A. Employee interviews, B. Manual review of documents, C. Data analytics, or D. Customer feedback? The answer is C. Data analytics. Data analytics is effective in detecting fraud as it analyzes large volumes of data to identify patterns and anomalies indicative of fraudulent activities. How does a strong organizational culture contribute to fraud prevention? Is it A. By enforcing strict penalties, B. Through extensive surveillance, C. By increasing financial rewards, or D. Promoting ethical behavior and accountability? The answer is D. Promoting ethical behavior and accountability. A strong organizational culture promotes ethical behavior and accountability, reducing the likelihood of fraud by encouraging employees to act with integrity.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit Birdsy.ai for complimentary study sessions with Birdsy, your AI-powered study partner.
Consumer protection and fair lending. What is the primary purpose of the Truth in Lending Act? Is it A. To regulate interest rates on consumer loans, B. To ensure consumers are informed about the costs and terms of credit, C. To provide insurance for defaulted loans, or D. To set maximum loan amounts for consumers? The answer is B. To ensure consumers are informed about the costs and terms of credit. The Truth in Lending Act aims to promote informed consumer credit decisions by requiring clear disclosure of loan terms and costs. It ensures consumers understand the true cost of borrowing. Which of the following is a key requirement of the Equal Credit Opportunity Act? Is it A. Prohibiting discrimination in credit transactions, B. Setting interest rates for mortgage loans, C. Limiting the amount of credit a consumer can obtain, or D. Providing government subsidies for first-time homebuyers? The answer is A. Prohibiting discrimination in credit transactions. The Equal Credit Opportunity Act prohibits discrimination in credit transactions based on race, color, religion, national origin, sex, marital status, or age, ensuring fair lending practices. How does the Home Mortgage Disclosure Act enhance consumer protection? Is it A. By setting minimum down payment requirements, B. By regulating mortgage interest rates, C. By requiring lenders to report public loan data, or D. By providing grants for low-income housing? The answer is C. By requiring lenders to report public loan data. The HMDA requires financial institutions to report public loan data, which helps in identifying discriminatory lending patterns and enforcing fair lending laws. Which act requires lenders to provide a loan estimate within 3 business days of receiving a mortgage application? Is it A. Equal Credit Opportunity Act, B. Truth in Lending Act, C. Home Mortgage Disclosure Act, or D. Real Estate Settlement Procedures Act? The answer is D. Real Estate Settlement Procedures Act. The Real Estate Settlement Procedures Act mandates that lenders provide a loan estimate to borrowers within 3 business days to ensure transparency and understanding of loan terms. Ethical practices in mortgage origination. What is a key ethical consideration when a mortgage originator assesses a borrower's ability to repay a loan? Is it A. Maximizing lender's profit, B. encouraging borrower to take a larger loan. C. Ensuring borrower's ability to repay. Or D. Minimizing documentation requirements. The answer is C. Ensuring borrower's ability to repay. Ethically, a mortgage originator must ensure that the borrower has the financial capacity to repay the loan, avoiding predatory lending practices that could lead to borrower default. In mortgage origination, what is the ethical approach to handling a borrower's confidential information? Is it A. Strictly maintaining confidentiality, B. Sharing with third parties for better rates, C. Using information for marketing purposes, or D. Storing information in unsecured locations? The answer is A. Strictly maintaining confidentiality. Maintaining confidentiality is crucial to protect the borrower's privacy and comply with legal standards, ensuring trust and security in the mortgage process. Which practice is considered unethical when originating a mortgage loan? Is it A. Offering competitive interest rates, B. Providing false information to clients, C. Explaining loan terms clearly, or D. Assessing creditworthiness accurately? The answer is B. Providing false information to clients. Providing false information to clients undermines trust, violates ethical standards, and can lead to legal consequences for both the originator and the lending institution. Why is it unethical for a mortgage originator to steer clients towards specific loan products for personal gain? Is it A. It enhances client trust, B. It improves lenders' market share, C. It simplifies the loan process, or D. It prioritizes originators' interests over clients? The answer is D. It prioritizes originators' interests over clients. Steering clients for personal gain prioritizes the originator's interests over the client's, violating fiduciary duty and potentially leading to unsuitable loan products for the borrower. Advertising and anti-steering rules. What is the primary purpose of anti-steering rules in mortgage lending? Is it A. To increase the profitability of lenders, B. To simplify the loan application process, C. To protect consumers from being directed to less favorable loans, or D. To promote competition among loan originators? The answer is C. To protect consumers from being directed to less favorable loans. Anti-steering rules are designed to protect consumers by ensuring that mortgage loan originators present multiple loan options, preventing the steering of borrowers towards loans that benefit the originator more than the borrower. Which of the following practices is prohibited under advertising ethics for mortgage lenders? Is it A. Using misleading statements about loan terms, B. Offering discounts on closing costs, C. Promoting loans with competitive interest rates, or D. Advertising special programs for first-time buyers? The answer is A. Using misleading statements about loan terms. False advertising, including misleading statements about loan terms or rates, is prohibited to protect consumers from deception and ensure transparency in mortgage offers. How do anti-steering rules impact the relationship between mortgage brokers and consumers? Is it A. They allow brokers to prioritize their commissions, B. They require brokers to present multiple loan options, C. They limit the number of loans a broker can offer, or D. They eliminate the need for consumer consent? The answer is B. They require brokers to present multiple loan options. These rules ensure that brokers act in the best interest of consumers, offering multiple loan options that suit their needs, thereby fostering trust and transparency in the lending process. Why is transparency in advertising crucial for mortgage lenders? Is it A. It increases the lender's market share, B. It simplifies the regulatory compliance process, C. It allows lenders to charge higher fees, or D. It helps consumers make informed decisions? The answer is D. It helps consumers make informed decisions. Transparency ensures that consumers fully understand the terms and conditions of loans, which helps them make informed decisions and protects them from potential fraud or misrepresentation. Uniform state test content. Licensing requirements and procedures. Which of the following is a primary requirement for obtaining a mortgage loan originator license under the Uniform State Test? Is it A, passing a background check, B, completing pre-licensing education, C, having a minimum of 2 years of experience, or D, joining a professional association? The answer is B, completing pre-licensing education. A key requirement for obtaining an MLO license under UST is completing pre-licensing education. This ensures that applicants have the necessary knowledge and skills to perform their duties effectively. What is the minimum passing score required for the Uniform State Test to obtain an MLO license? Is it A, 60%, B, 70%, C, 75%, or D, 80%? The answer is C, 75%. The minimum passing score for the UST is 75%. This standard ensures that applicants demonstrate a sufficient understanding of the material covered in the exam. Which of the following actions is required before an MLO can apply for a license renewal under UST? Is it A, submitting a new background check, B, retaking the UST exam, C, providing updated employment history, or D, completing continuing education? The answer is D, completing continuing education. MLO must complete continuing education annually to renew their licenses. This ensures they stay informed about industry changes and maintain their professional competence. How often must a mortgage loan originator fulfill continuing education requirements under the UST? Is it A, annually, B, every 2 years, C, every 3 years, or D, every 5 years? The answer is A, annually. MLOs are required to complete continuing education annually. This ensures they remain knowledgeable about current laws and practices in the mortgage industry. Surety bonds and financial responsibility. What is the primary purpose of a surety bond in the context of mortgage loan origination? Is it A, to provide insurance for the mortgage originator against losses, B, to protect consumers by holding the originator accountable, C, to guarantee the lowest interest rates for borrowers, or D, to reduce the risk of foreclosure for lenders? The answer is B, to protect consumers by holding the originator accountable. A surety bond in mortgage loan origination primarily protects consumers by ensuring that the mortgage loan originator adheres to regulatory standards. It provides financial recourse if the originator violates laws or regulations. Which entity typically requires mortgage loan originators to maintain a surety bond? Is it A, state regulatory agencies, B, Federal Reserve, C, Consumer Financial Protection Bureau, or D, mortgage companies? The answer is A, state regulatory agencies. State regulatory agencies require mortgage loan originators to maintain surety bonds. This ensures originators comply with state laws and provides financial protection to consumers. How does a surety bond benefit consumers in the mortgage industry? Is it A, by lowering mortgage interest rates, B, by increasing loan approval rates, C, by enhancing the lender's financial security, or D, by providing financial protection against originator misconduct? The answer is D, by providing financial protection against originator misconduct. Surety bonds benefit consumers by ensuring mortgage loan originators adhere to legal and ethical standards. They provide a financial remedy if the originator engages in misconduct or fraudulent activities. What happens if a mortgage loan originator fails to maintain the required surety bond? Is it A, they must pay a fine but can continue operations? B, they are required to increase their bond amount? C, their license may be suspended or revoked? Or D, they can operate under probationary status? The answer is C, their license may be suspended or revoked. Failure to maintain a surety bond can lead to suspension or revocation of the mortgage loan originator's license, as it is a mandatory requirement for legal operation. Record keeping and reporting requirements. What is the minimum period for which a mortgage loan originator must retain records of consumer complaints according to UST requirements? Is it A, 1 year, B, 3 years, C, 5 years, or D, 7 years? The answer is B, 3 years. The Uniform State Test requires mortgage loan originators to retain records of consumer complaints for at least 3 years. This ensures that any issues can be reviewed and addressed if necessary. Which of the following documents must be included in a mortgage loan originator's record keeping according to UST standards? Is it A, employee timesheets, B, office supply receipts, C, loan applications, or D, marketing materials? The answer is C, loan applications. According to UST standards, loan applications and related documentation must be retained. This ensures transparency and accountability in mortgage transactions. Under UST guidelines, what is the primary purpose of requiring detailed record keeping by mortgage loan originators? Is it A, ensure compliance with legal requirements, B, facilitate marketing strategies, C, reduce operational costs, or D, improve employee performance? The answer is A, ensure compliance with legal requirements. The primary purpose of detailed record keeping is to ensure compliance with legal and regulatory requirements, which helps maintain transparency and accountability in mortgage transactions. What type of reporting is required by UST for mortgage loan originators to ensure adherence to anti-money laundering regulations? Is it A, annual financial statements, B, customer satisfaction surveys, C, quarterly tax reports, or D, suspicious activity reports? The answer is D, suspicious activity reports. Mortgage loan originators must file suspicious activity reports to comply with anti-money laundering regulations, helping to detect and prevent financial crimes. Prohibited conduct and disciplinary actions. Which of the following actions is considered prohibited conduct for a mortgage loan originator under the UST? Is it A, providing a detailed loan estimate, B, offering a lower interest rate than advertised, C, making false promises to influence a borrower, or D, disclosing all fees up front? The answer is C, making false promises to influence a borrower. Prohibited conduct includes actions that are fraudulent, deceptive, or unethical. Making false promises to influence a borrower is considered unethical and can lead to disciplinary action. What disciplinary action may be taken against a mortgage loan originator found guilty of prohibited conduct? Is it A, revocation of license, B, reprimand with no further action, C, mandatory community service, or D, temporary suspension of advertising privileges? The answer is A, revocation of license. Disciplinary actions can include suspension or revocation of the license, fines, or other penalties. Revocation is a severe consequence for serious violations. Which scenario could lead to disciplinary action under the UST for a mortgage loan originator? Is it A, providing accurate loan terms, B, falsifying income documents for a client, C, offering competitive interest rates, or D, conducting thorough credit checks? The answer is B, falsifying income documents for a client. Engaging in fraudulent activities, such as falsifying documents, is a serious violation that can lead to disciplinary actions, including license revocation. Under the UST, which of the following is considered a deceptive act by a mortgage loan originator? Is it A, accurately disclosing APR, B, providing a good faith estimate, C, offering a no-cost loan option, or D, misrepresenting loan terms to a borrower? The answer is D, misrepresenting loan terms to a borrower. Misrepresenting loan terms to a borrower is deceptive and violates ethical standards, potentially leading to disciplinary actions.